We saw earlier that the central banker decides what should be the level of the money supply in the economy, whether it should be M1 as shown in the previous chart or higher or lower. The second key thing to know before understanding monetary policy is how central banker affects money supply in the economy. Let's meet Mr. Central Banker and ask him more about the tools that he uses to control money supply in the economy. Mainly, I have three tools to control money supply, and they are reserve requirements, open market operations, and discount rate. Reserve requirements. It influences how much money the banking system can create with each dollar of reserves. An increase in reserve requirements means that banks must hold more reserves and therefore can loan out less of each dollar that is deposited. So when I increase the reserve requirement, it decreases the money supply in the economy. Conversely, a decrease in reserve requirements lowers the reserve ratio, raises the money multiplier, and increases the money supply. The second tool that I use is open market operations. I conduct open market operations when I buy or sell government securities, that is G-SECs, from the public. To increase the money supply, I buy back the government securities that are with the banks. The money I pay to the banks for buying back the government securities increases the total money available with the banks and hence increases the supply of money in circulation for onward lending. To reduce the money supply, I do just the opposite. I sell government securities. The financial system pays for these government securities with its holdings of currency and bank deposits, directly reducing the amount of money in circulation. In response, banks reduce the amount of lending and the process of money creation reverses itself. The third tool that I use is the discount rate, the interest rate on the loans that the central bank makes to banks. When the central bank decreases discount rate, banking system borrow more from central bank and the banking system has more money than it had before, and this additional money can be lent onwards. So, decreased discount rate increases money supply in the economy. The central bank can alter the money supply by changing the discount rate. When the central bank increases discount rate, it discourages banks from borrowing from the central bank. So, they borrow less and banking system have less money than it had before. Thus, an increase in the discount rate reduces the quantity of reserves in the banking system.